and that's towards the end of the cycle where we're at today, where the yield curve starts to uninvert. That yield curve uninverting is when gold starts to outperform. Gold is, quote, the safe haven asset. So that's where it earned its name, safe haven, because when the yield curve uninverts and that impulse of inflation starts to slow down, the yield curve starts to normalize. That is the slowdown and, quote, the safe haven aspect of gold, and that's when it outperforms. And that's exactly where we're located right now, is that impulse of the inflation is slowing down, the yield curve starting to uninvert, and gold is outperforming. It is a marker of where we're at in the business cycle. Gold leads, and what comes next is generally...
Hey guys, my name is Danny. I'm a data scientist, and you're watching Capital Cosm. Today, we've got a very special guest returning on the show. It is Andy from Finding Value Finance. Andy, my good friend, how you been?
Pretty well. Thanks for having me back on and inviting me back on the show. So thank you for having me back on, and I'm doing great.
Yeah, the audience always likes it when you're on, Andy. I think you offer a pretty unique composite of insights between your technical analysis and your fundamental analysis. You've kind of coined the term. You're more of a hybrid, and I really enjoy the analysis you bring to the table. But before we get started, guys, I'd like to remind you to watch the full scope of this interview. You're going to have to log into Substack. We do have a free portion here on YouTube, but for the full interview, you're going to have to check out our Substack. Link to that is down below. It's capitalcosm.substack.com. And yeah, if you're enjoying these interviews, it doesn't hurt to give us a like, subscribe to the channel if you're getting value out of it, and comment down below. Let us know what you think. Okay, so Andy, let's just take it from the top. Let's start off macro, and we can hone in on specific topics as they come our way. What is your general view of the markets right now, as well as the economy? The two are separate, right? So let's just start off with the markets, and then if you want, we can kind of trail off into the economy aspect of it as well.
Well, I view them kind of interconnected to some degree. They're not completely interconnected.
Right.
They are a little bit. I start with the yield curve. The yield curve, we gain information looking at the yield curve. The yield curve is uninverting. So we've got what's going on been recently. We've got it's called the bull steepener, where the long end of the curve's been coming on up, and the short end of the curve has come on down or remained kind of resilient or moving sideways. So what's happening is the curve is basically normalizing. We're coming from an inverted state, uninverting the curve to a more normal state where the 2-year falls below the 10-year. When that occurs, that is generally when we see a slowdown in the market. When those slowdowns occur, we generally see the yield curve fall, and the 2-year falls faster than the 10-year. That is usually what we see in recessionary movements. We've got a bull steepener, which means the long end of the curve has been going up. So the past few weeks. So that's a little bit different than a outright recession. That's pricing in what I think might be a little bit more inflation and the unwillingness for people to want to hold the long end of the curve. So it's a difficult read because you do have unemployment starting to come on up. You do have the 2 and 10 uninverting, but it's doing it in a way that's a little bit different than, say, previous times in history. So I take notice to those things. I don't know, what's going to happen here in the short term if we're going to get some sort of event or something like that, because a lot of the times when an event occurs, it occurs when the yield curve's falling and a lot of people are positioned in bonds already. So the short term is a little bit tough to figure out. And with the market conditions we have today, looking at the markets, the most direct way to play that would be gold and silver. That's your tailwinds behind that sector. Everything's aligned for that sector. It's cheap in relationship to other asset classes. So that's where I think the most tailwinds are behind a certain sector is gold and silver. And I think silver looks fantastic. I think it's ready to just absolutely rip. So that's kind of my high level kind of looking out there and what I'm using to kind of make that decision, partially make that decision.
Could it also be a case in with respect to the yield curve in terms of what it's signaling? Could it also be stagflation, where you get in a recession as well as commodity side inflation?
Yes, it very well could be that. And that's kind of what we're seeing with the 30-year holding steady or moving up, and then the 2-year kind of whittling down. We very well could get a slowdown slash inflation, but that would be jet fuel for gold and silver. I mean, that's the exact location that you'd want to be in. So if we get so the difficult part to get right in a short term, time frame is we can see things are slowing down in terms of the yield curve uninverting, the unemployment kind of drifting higher. A lot of people are expecting that unemployment rate to really start to take off, and that's your recession. But then you look at the long end of the curve, it's like, wait, this is coming up a little bit. That's your inflation peeking its head through there. And some sectors that are inflation sensitive are also sensitive to demand. So you've got these counteracting forces hitting each other, like oil. Oil is very inflation sensitive, but yet it's also sensitive to demand and then the perception around the demand for oil. There are areas in the market that are slowing down, like China. China is going through a deleveraging process. Their real estate market is in a quote recession recovery phase. It came on down and it's trying to recover. And that's where they're at in their cycle. Their demographic has fallen off a cliff. So I look over there and I'm like, that looks pretty weak over there, which is impacting oil prices. That's your demand side and the perception of demand being weak. They are doing stimulus to try to kickstart their economy back up, but I don't know how well that will work. A lot of the spending that comes into the system, a lot of the credit that comes into the system comes from monetary bank lending against real estate. And if you go through a real estate crisis or a deleveraging, your slowdown can't get reignited if your demographic doesn't exist to buy the homes. So that's kind of the situation they're in with their slowdown, and they're trying to reignite it, doing all this stimulus. If they try to stimulate it from the monetary side, I don't know how successful they will be because lowering interest rates into a demographic that doesn't exist, you don't sell more homes to someone who isn't there. Japan did something very similar to that, looking at Japan. When their demographics started to fall off, their housing market rolled over and went down, 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 down. And that was, in my opinion, one of the root causes of them not being able to reignite inflation. They had disinflation or deflation over a long period of time because their real estate market never really rebounded and no credit was coming from the monetary side of bank lending. So if they want to basically kickstart this thing back off, I think you have to go fiscal and start just spending on projects, programs, and go ballistic on that side. So that's kind of the Chinese side, and that has been, I think, stagnating stuff like copper, energy like oil, coal, and all those areas. We've kind of just drifted lower and have been going sideways in those. And if you notice, they announced some super stimulus coming out, we'll call it. They've doubled down on their stimulus, and you can see the sectors that are benefiting from that. You can see steel going up. You can see oil going up. You can also see nat gas and some coal. And then copper's been hitting pretty hard too to the upside with this stimulus coming out. I don't know how sustaining it will be. So that's the toughest part is when we transition with this yield curve going from inverted to uninverted or normalizing. What does that transition look like? A lot of people try to guess. They try to position for it. They try to say that a recession's coming. They sell their stuff and go to cash and buy bonds or whatever they think is a good play for that. I think gold is the best play. And then they try to time their entry point too. And sometimes they miss that. They could mess that up. So if you're trying to buy something that's cheap, we're in this type of market condition. The way that I would do it is I would hedge myself with time. So if you're going to try to buy a bottom in something, whatever it is, it could be copper companies, coal companies, energy companies related, whatever it is, you can hedge yourself with a bunch of time. So if you're wrong and it goes down, you can buy more, you can dollar cost average in, and then take a long enough time frame where when things start to rebound, it comes back. You can hedge yourself at that time. You don't have to be perfectly timed the bottom, and you can kind of cost average in and get the best price as long as you can control your emotions and hold on. The technical analysis people will say I'm crazy for trying to catch a bottom and buy it at the cheapest prices. Catching a falling knife, they've got all the sayings. But if you wait for it to bottom and break to the upside, emotionally it's a lot easier, but your total returns will be a lot less. So that's what I'll say there, with at least my tactics versus maybe some other people's opinions around
Yeah.
that.
So when you're dealing with this kind of stuff, Andy, how do you just detach yourself, from your emotions? A lot of people struggle with that. Is it just simply, inherent temperament that you either got it or you don't? But for those out there who may struggle with this, what are some tips that have helped you along the way?
Well, I think I think part of it is learned and part of it is temperament. I don't think all people can learn it, but I think a lot of people can. And I don't I don't think it just relies solely on knowing the sector fundamentals or anything like that. I think you have to have experience with it. So you kind of have to. It's almost like you need to be handheld a few times so you know what it looks like. Once you retrain your brain to look and see what bottoms look like, and then see and feel what they look like, to understand what the herd is thinking, how they feel, the emotions behind it. I mean, that's the whole game. Our default position as humans, we come into this world, and what we want to do is we want to fit in. We want to fit into society. We want to fit into our cliques or whatever, our friends. We want to be accepted. That's kind of our default position, but that doesn't work in investing. The default position of falling into the herd is the exact opposite of what you want to do. So I think you can learn it. I think it is trainable for the majority of people. It's just you don't know what to look for and you don't know what it feels like. You don't know because it's not set up in your quote default position of how you come into this world and trying to be accepted and fit into society and whatnot.
You kind of have to be an
So
aberration to be good at this stuff. Like you have to be an oddball, by definition, to be kind of good at this stuff.
I mean, if you think about it, um, the way the markets move is a resultant of the majority in the default position. Like that is how you're getting these movements. That's how you're getting the emotions and all that stuff. That's how humans behave and act and how they come into the world in I call it the default position, emotional position, or how they are grown up and taught in society. And when you want to become a good investor, you almost have to figure out and learn a different way of looking at things. You have to get out of that default position. Once you retrain yourself, you can't, I mean, you'll see it in a different light. So if you understand that the markets are, there's a couple of things that I would say you need to understand and the way to get out of the default position. This is what I've created. I call it the three pillars: technical analysis, ratios, and market conditions. The market conditions are cycles. The cycles, we can tell where we're at in that cycle using the yield curve. That's why I was talking about the yield curve in the beginning. Once you kind of figure out, okay, I know where this cycle's oriented, and then you can kind of look at the cycle and say, well, people act a certain way in some of these areas. So you can use sentiment, you can use cycle analysis, you can use technical analysis, and you can kind of gauge using ratios too where we're at with some sort of degree of confidence. And that's why I came up with those three sectors, or three pillars and areas. So you can kind of say the sentiment's crap, it's cheap, and no one's in it. And we're at the bottom of the cycle, and you could use the business cycle, is what I'm referring to. And you can kind of say this is a good location to be potentially buying in. The problem is you can't pinpoint a bottom with precision, and accuracy. It's like you can get in the general area of where something's good to buy, but you can't get within pennies of the bottom. I mean, you could luckily, but it's real hard to do that. And you can use all sorts of technical analysis like Elliott wave theory and all these things to try to pinpoint that bottom. But the thing that I would say is don't try to catch the absolute bottom. Make yourself resilient, get a strategy, and say, let's get this bottom area, cost average in to try to get the best price. And then be patient enough for it to turn and the cycle to turn back into favor, where the sentiment turns from negative to more positive. The technicals are just an extension of sentiment and the herd mentality. The technicals are more or less a charting of the default herd position of emotions. And Elliott wave theory is just, it's an explanation of how the emotions of the herd are trading with each other and create these patterns. And the herd, or the emotion of the herd, is something that repeats over time, and it repeats in a pattern very, or what I would say, somewhat reliably. So technical analysis, Elliott wave, the normal kind of conventional technical analysis, the patterns like inverted head and shoulders and all those things, those are all just ways to explain or describe the herd and the way that the herd is behaving within each other, and then the patterns that they generally create at bottoms, tops, and middles. So that's all it really is. And then the cycle analysis and ratios can tell you good value or bad value. So then you kind of like, you add it all up together and it creates a picture, at least the way that I view it and the way that I view it through my eyes. So yeah, I mean, that's kind of how I would describe it. And it's not a default position, and you have to learn. And I just create those things to take out some of my emotion and use more data, logic, and ways to look at the market without using news or using things that may have biases set into them. I also think I wouldn't use news at all, because I have a feeling that some of these people are trying to manipulate others to offload positions into. So Jim Cramer, I think he knows what he's doing. You can't be wrong that frequently. And if you're wrong that frequently, that means that like he probably knows what's going on in his buddies. It's like, dude, offload to this retail. I'll create the buying pressure for you. So they get people interested to get the buying pressure in, and then they can offload their shares at a top or something like that. Because it's very rare if you're that wrong that often. So the approach would be find someone, or how to fix this to get out of the default position is find someone where you can latch on and learn from, because you can't. That's going to expedite your learning process so much faster than trying to do it by yourself. Then you can see what it looks like, feel what it looks like, and you can ask questions as you go through it. Because if you're at a bottom, you're still going to get volatility. You could still be down 20, 30, 40%, even though the stock is down 80, 90% from its high. And then you have to say, well, how do you know it's a good position? How do you know that this low down here is still a good area to buy in? Because I'm down 40%. Do I continue to purchase, or do I sell the position, take the loss, and it's just done? The biggest mistakes that a lot of people make is they don't hold long enough. So they get the right location, but they don't have the mental fortitude to hold on long enough. They think that if it doesn't occur in a month or two, that it's not working. But it takes longer than that. So in order to be a master of the game, so to speak, you need to be a student of it. And then you have to change your entire default position of what you're in from an emotional state and expectation state. And it has to match whatever the game you're playing. And if the game is the stock market, a lot of these cycles, they play out over an 8 to 10 year period. Historically, they might go longer, they might go a little shorter. So around 8 or 10 years, the real estate cycle is 18.6. You get, like a down 4 or 5 years down, and then you get another recovery and expansion phase, which you almost have to kind of completely wrap your mindset around all that. If you don't, you're forcing something that's not going to occur, and then your expectations don't match what the market is going to do. So you're just going to get ground up the entire time because your time frames are not matching what the game is, so to speak. So hopefully I gave enough background on that, at least my opinions on it, and how to be a little bit more successful in approaching the markets versus people in the quote default position.
Yeah, all valuable information. I look at the commodity complex, and we had a very good run from 2020 all the way up until 2022, about a 300% run, or 2 to 300% run, depending on which index you look at, whether it be the Thomson Reuters one or the Goldman Sachs one. But since then we've corrected quite a bit. And I guess this is where a lot of this unease comes from, especially in commodity investors, is that we haven't seen any decent performance on the commodity side for the better part of 2 years now. But we are starting to see some glimmers of hope by way of the precious metals side of things. You did allude to the fact that the precious metals are ripping it right now, which is quite evident to see. It's essentially another day, another all-time high in gold, as we've come to say lately. We're sitting at 2660 on the gold price at the time of this recording. Silver is also doing quite well at $31 and some change. However, silver has not begun to outperform gold, which is your telltale sign of a precious market. Maybe we are in a bull market, but Patrick, our good friend Patrick Kareem, he likes to call it a bull era. Have we entered this bull era yet in precious metals, or will that not start until silver outperforms gold? And where do you see silver at right now? You did mention it was highly not asymmetrical. I don't think those are your words, but you see a lot of upside in silver. So I'll let you take the floor there. What do you see in the precious metal space, and then particularly on the silver side?
So I think we have entered the era. The era is measured by gold against other assets like gold to S&P 500. So I think we're entering that era right now. When the yield curve inverts, so when we get these pulses of inflation, those pulses of inflation are generally driven by the real estate cycle and the demographic coming through home buying years, and then they create credit in the system. That's looking backwards historically. Impulses could also be created by stimulus and or fiscal spending. So when we get these impulses of inflation into the system, it inverts the yield curve. Commodities also expand because the credit being created in the system puts everything into a shortage. So oil being the closest or number one commodity to that inflation is the one that benefits the most. That's why it's a very inflation sensitive asset. It's the number one commodity. So you get an impulse of stimulus, credit, whatever it is, and then you start to see things react because oil and these commodities cannot react fast enough to the credit creation. So it puts everything into a shortage, so to speak. And then you get inflation. Inflation is a shortage of those commodities. Essentially, it's too much money chasing too few of goods. And then it pulls everything in the system into the manufacturers and stuff like that to produce. So that impulse move that we got in 2020 came up, and then it started slowing down. They raised rates. They started slowing that credit expansion, and then they slowed on down. And that's towards the end of the cycle where we're at today, where the yield curve starts to uninvert. That yield curve uninverting is when gold starts to outperform. Gold is, quote, the safe haven asset. So that's where it earned its name, safe haven, because when the yield curve uninverts and that impulse of inflation starts to slow down, the yield curve starts to normalize. That is the slowdown and, quote, the safe haven aspect of gold, and that's when it outperforms. And that's exactly where we're located right now, is that impulse of the inflation is slowing down, the yield curve starting to uninvert, and gold is outperforming. It is a marker of where we're at in the business cycle. Gold leads, and what comes next is generally the bottom of some cycle will come. We'll see silver outperform on the back half of this cycle, and it generally outperforms when they do stimulus or credit creation, or we start to see that stuff come into play. So we'll see silver start to outperform at some point, because what it's doing is it's front running that stimulus, the lowering of rates, all that stuff. So I think gold's our leader, which is going. Silver's going to hit next, and then your inflation sensitive stuff's going to come after, shortly thereafter. Now, the time frame and the precision of all this and the sequence of events that I just said, the sequence of events I think are right. I just don't know like the time of each. Um, I don't know if you'll ever be able to precisely get it perfect. But these guys who outperform, like the Stanley Druckenmillers and all these guys, they know this cycle, and that's what they're playing. They're playing the sequence of events, and they've just been able to do it over all these years, use their experience, see the sequence of events, and then you can also see the sentiment and the humans and how they behave all behind it. It's all interconnected. So right now we're entering that bull market in gold. The next phase, in my opinion, is a weakening of the dollar. So we're going to start to see the rates come down. And what I would be looking at is your dollar to see if the dollar starts to weaken. If the dollar starts to weaken and we get weaker and weaker dollar, that is the denominator of our commodities being priced with something that's losing its value against other currencies. And we're also going to see money flows shift in the market differently. A lot of people, when they invest overseas and here, they want to see a strong stock market and a strong currency. So they're playing it twofold. They're playing the price appreciation of the market, and they're playing price appreciation of the currency. So if you have a strong United States stock market and a strong dollar simultaneously, and you're living in another country that is a non-dollar denominated currency, you can put your money in that market and earn currency exchange differences and returns on the US equities. It's a twofold thing. Now, if that reverses and we have underperformance of US equities and the dollar starts to drop, all of that money rotates into different things. So I think that is going to occur. I think the emerging markets areas, I think, are really good spots to look at. I think you're going to see potentially outperformance of commodity currencies here. This is the beginning of that next leg of the commodity bull market. It's very similar to 2001, 2002. We went through that tech cycle in 2000, 2001. We had the slowdown. They lowered back interest rates. The dollar started to fall against the Canadian dollar, against Brazilian real and other currencies. And the commodity sector just ripped. Gold and silver ripped. All of the things and the data that I look at and the ratios of where we're located makes me think that we are in a similar situation to 2000, 2001. Tech is very expensive. Commodities are very cheap. We've got an increasing interest rate environment, very similar. And then we could get a lowering of that interest rate, which I think could kick a lowering of the dollar. And if that's where we're located, what we should be seeing and what we should be looking at are the commodity sectors and emerging market sectors. And through technical analysis, we should be saying, okay, are they putting in bottoms or not? We should also be looking at the currencies. Is the dollar doing weaker against the Canadian dollar? Is it looking weaker against some of these other currencies? And if the answer is they're looking like they're putting in bottoms, I mean that's your answer there, is what I would
Yeah.
say.
What about platinum? I've heard you talk about platinum on your channel. What do you make of platinum's uh, current valuation?
So platinum is an absolute steal. It's like the play of all the metals, in my opinion. It's been lagging, and a lot of people are getting frustrated with it. But when the dollar drops here, and I think it will occur. I don't know when it will exactly occur, but I think it'll occur over the next 6 to 12 months. Platinum is the cheapest of the metals in a ratio perspective against silver, gold, and palladium, and even rhodium. It is cheap against. Whenever you get that type of alignment, you get well, and it's got huge asymmetry too. Asymmetry, big upside, small downside risk here. It's got all of the what I consider the alignment that I look for of all of everything. Cheapness, the market, the technicals look very good, and The cycle's coming, it's bottomed right now, and it's going to start to come into favor soon. I think it will come into favor when that dollar drops. It's very highly correlated to inflation. It's the most inflation sensitive metal of the other, versus gold and silver. So gold is the safe haven. Silver is kind of close to it, and then platinum comes behind it. Platinum's more correlated with oil than it is with some of the, it's got a cross between gold and silver and a cross between oil because there is some inflation sensitivity there. So I think that will come next. And when we start to see platinum start to outperform, it is telling you about the market condition we are in if it starts to outperform silver and gold. Gold is the safe haven. And when we transfer into this next cycle, we can use the ratios to say, yep, this is starting to outperform. We're getting more into an inflationary part of it. And we can also use oil too. And that'll be next, in my opinion. So I think platinum's fine. It's just we haven't gotten into its full on cycle yet of alignment.
Yeah, and what about the rest of the commodity space? Who do you so is platinum your I mean, as far as you're willing to answer this question, is platinum your most asymmetric commodity right now, or are you more bullish on anything else? What's your most bullish sector in your opinion?
Like short term or longer term?
Let's go with both.
So short term, I think gold is really good, and I think silver is going to be your most asymmetric in the short term. Longer term, if you take everything away and strip it, I think the most asymmetric play overall is probably natural gas or oil. And right now, they are really, really low in relationship to gold. Gold's the leader, so gold's ripping. Go, 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 go. And then we've got behind it the lagging crude oil at $70. So our ratio is up around, I haven't looked recent, but it's around 37, 38. So 1 ounce of gold can buy 37, 38 barrels of oil. That is incredibly cheap compared to history. And then nat gas is cheap to oil. I mean, nat gas is like basically free compared to history. So looking forward, what I try to do is I look to see where the imbalances in the market are and how balanced we are. We have a lot of natural gas demand coming. It's going to come from artificial intelligence. It's going to come from electrical power generation. It's going to come from heating. It's going to come from these LNG terminals, at least in America, being built to go out and supply the world with natural gas. We are the cheapest natural gas area, and everywhere else it's more expensive. So when we get more interconnected with the overall market, I think that natural gas in America will go higher, and maybe it goes lower internationally, and then it'll stabilize somewhere in between. With where we're positioned with natural gas today, and where I think demand is 10 years out from now, I think the highest probability with the most asymmetry in the markets today is probably natural gas from a longer term perspective. Oil is probably pretty close behind it. I know a lot of people look at they look at how much natural gas and how cheap it is today, but you also have to understand that the conditions today were a resultant of 2 warm winters and basically adding inventory levels on top of each other, stacking it up over warmer winters. That could shift dramatically very quickly depending on weather related events. So I wouldn't, it is very heavy weather dependent at this time. And as the interconnection gets established with LNG terminals, I think that weather may dampen a little bit. It won't be as big of as an effect, but that's where I think the most asymmetry is longer term. Oil is another one because I think oil is going to have problems out in the future. Whenever credit gets expanded as fast as what I think is coming in terms of fiscal spending and maybe even a little bit of credit in the system, we're coming into this liquidity cycle. Everywhere in the world's easing at this time. So credit's going to be coming into the cycle. If credit comes into the cycle, what it does is it puts everything into a quote shortage. And oil is the closest to that. Same with platinum's a very sensitive inflation one too. So it takes time for this easing to get into the system. It takes time for this money to kind of rotate into the system, maybe 12, 18 months or something like that. It'll come into the system, put everything into a shortage, and the most symmetry would be nat gas, oil, and probably platinum on the longer term. Short term, with where we're at this second and the easing cycle that we're in, silver would be the best on the short term.
Hey guys, quick pause. If you're enjoying this content and this channel as a whole, but want to take the experience up a notch, then consider joining Capital Cosm Club here on Substack. You get access to exclusive portions of my interviews that you won't find on YouTube. You'll have the opportunity to ask my upcoming guests a question. You'll also get the chance to recommend me guests. You'll get a chance to DM me. My DMs are open on Substack for paying members only. Talk about whatever you want to talk about. And we also do market write-ups. And with that said, I'll let you get back to the video. Thanks, guys. Yeah, so you did allude to the fact that we are entering this kind of a capital rotation event like we saw in 2000. Be that as it may, the markets, the broad market that is still hitting all-time highs. Is this simply a case of, the markets are going up or ripping higher, but the commodities might rip even higher on a ratio basis? Or are you anticipating a correction on the broad market side to kind of help play that ratio out from moving capital from the markets over to the commodity side? How do you view the ratio shaping out over the next couple of years?
So short term, it's difficult to get it, nail exactly precisely what it looks like. But the way that I view it is, if I'm going to buy something in the market, I want a large margin of safety. I want the asymmetry. And then when I look at technology stocks, it's like they're expensive. They're expensive on a ratio perspective. There's no reason to be there. So I would rather wait in something that's undervalued than get immediate returns potentially and have a bunch of risk of getting caught in a whirlwind of a crash. So your risk reward is not there in technology stocks. Now, the timing and how this is going to play out, usually what we see is when the yield curve uninverts, unemployment goes up, we see the tech sector usually, somewhere in the stock market fall because we go through a slowdown. When that occurs, that's the beginning of a rotation of money. Right, is usually when these things start to rotate a little bit differently. So we could, and I don't know with 100% certainty, but we could be at the beginning of a rotation eventually here, where tech stocks start to slow down. Maybe we have a blow off top left in it. And then we rotate eventually into commodities, and that ratio starts to move. The tough part is when exactly will that occur? It's hard to know. I would have guessed, we would get a slowdown here any second, and that we see technology kind of slow down, and it could grind sideways, it could pull back, it could go down a lot depending on what occurs in the commodity markets. My guess is that the commodity markets will far outpace the overall stock markets at some point soon. And the reason I would say that is because of the shortages or the deficits that we could potentially see in a lot of these commodities. And that's going to occur 2025 onward, depending on what commodity you're looking at. Uranium obviously has a big deficit. That's going to have an impact at some point. Copper is going to have a big deficit at some point over the next few years. That's going to have a big impact. So I don't see how the consumers of commodities in these companies are going to benefit from a commodity shortage and increasing input prices. So I think we're right at the beginning of all this, and things will slow down. Yield curve uninverts. Technology may go sideways or lower at some point, and then money's going to have to rotate in to solve the problems that are located in commodities. The difficult part that I have is it's like some of these shortages are pretty big, and it's like how are they going to solve this with any sort of expeditious fashion? Like it's going to be really slow, and I think we're going to go into a very big bull market in commodities, and I don't know how it will be resolved very quickly. Another thing that I get a little bit worried about is the energy demand for all this. If AI is successful, AI is more or less so. technology is just a function of efficiency. That's all technology is. It's how to do something more efficiently. So technology can shrink things. It can store more data in the same space. It's creating a more efficient airplane or more efficient um, car, whatever it is. It's all about efficiency and trying to make a manufacturing facility from A to Z more efficiently. How do we do it faster? How do we reduce lead times and all that stuff? If it is wildly successful, what that means, in my opinion, is we're just going to consume more energy at an exponential pace. Because if you become more efficient at converting a company into, say, the design of something to a final product, you're going to be in. You need more inputs faster. You need more commodities to put through a company faster, 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 and faster, which really is just the conversion of energy. So AI, not only does it consume energy to do its critical thinking, we'll call it, but it will also consume a lot in whatever it touches because it's supposedly supposed to make everything that much more efficient. If it really does make everything more efficient, that means that we need to produce more commodities at a faster pace, which means we are going to suck down a lot more energy in a very small, time frame. So as we go exponentially higher in energy consumption, and energy is, I would say, the most versatile investment. You can do whatever you want with it. I think that's a really good opportunity, and that's where my asymmetry and my probability of success is rooted in, is what I just described there. It's like if all these things are going to come, and if they even are successful, it's just going to increase energy demand more than what we already have. So energy is kind of the basis of everything, and it's the most versatile that you can use. You can burn natural gas to get electricity. You can burn coal to get electricity, and I don't think people will really care where the electricity is generated from. And I think they're going to get pretty desperate because the expansion of energy demand will be so rapid that they're gonna use whatever they can. They're going to use coal. They're going to use nuclear. They're going to restart nuclear plants. They're going to do whatever they can, and you're going to see that 3 Mile Island and all these things. They're going to go back and start opening everything back up because we're going to be energy starved, and that's in order to grow economies, in order to sustain deficits, in order to increase GDP, you need exponential increases in energy consumption.
Well, I think that's all I got, Andy. If there's anything you want to talk about that we didn't get to, if there's any charts you want to show, feel free to. But if not, then go ahead and tell us where we can find you.
Yeah, you can. I've got a YouTube channel, Finding Value Finance. I also have a website, finding-value.com, where I go deeper into all these sectors, looking for individual investment opportunities and sector opportunities. And I teach too. I teach a lot of this to people during the question and answer sessions I have on the weekend. I teach them how to basically see what bottoms look like, what it feels like, what companies I'm going after, why I'm going after them. I'm documenting it all on the website too. I've got a Roth 401k that I've started from scratch, and I'm literally showing everybody how I'm building it. You can see everything, the positions I'm putting in. You can see the size of the positions. I put the charts and basically say, this is why I'm buying it, fundamentals, share count, like all that stuff. And then you can see me build it real time. So yeah, I got the website, and then Twitter, it is finding_finance.
Yeah, we'll have the links to both of those down below. So be sure to check them out, guys, if you are interested. Also, I'd like to remind you to check out our Substack if you haven't already, capitalcosm.substack.com. You don't want to miss part 2 of this interview, so be sure to check it out. Full interviews down below in the description box as well as the pinned comment. And also, if you got value out of this interview, be sure to give us a like, comment down below, go Andy, go. If you agreed with what Andy said, if you disagreed, let us know why. Really interested to get your take. And also, don't forget to subscribe to the channel. A little bit goes a long way in helping us. But yeah, thank you so much for coming on, Andy. We really appreciate your time. And I appreciate your time, guys. Thank you so much for watching. And we'll catch you in the next episode. Bye, guys.
It's gonna change the dynamic completely. The market won't even look like it does today. People won't even be able to recognize the market because you get inventory down to certain levels. So I'll describe this real quick. As we go through all of this demand increases, we haven't been increasing our inventory levels. So as a percentage, the inventory as a percent of days coverage is declining. So what that means is we're gonna start to see, in my opinion, more volatile natural gas prices. So as inventories drop, prices they're gonna rocket to the upside and say